I think we're closer to some sort of like Weimar Germany type inflationary thing than we think. And everyone's having a hard time staying above the inflation. Like you can feel it. You can feel it. Uh, I have three children. My healthcare costs are more than my mortgage. I mean, this is ludicrous. I mean, it's and I locked in my mortgage when rates were really low. So I think the only way out of this at this point is you have to be in a store of value, whether that is tech stocks or Bitcoin or something that has an inherent inflation protection in it. Because like nothing else makes sense in terms of the dollar. Like in a secular downtrend, yeah, I think it is at this point. I think Trump destabilized the capital system as we know it, even though we might temporarily be going back to it right now.
Well, yeah, on that point, that's where I've been, because as we mentioned in that first stat chat, there's the current account deficit, so like goods, but then there's also the other side of the equation, which is the capital surplus of US dollars going out to the rest of the world. And so now we're in the situation where, okay, they talked about wanting to narrow the current account deficit by basically tariffing goods. But as we're seeing is that there's a certain limit of what you can actually do there. Like 10%, the economy can probably survive through that, but at 30%, there's no chance. So, what if we flip to the other side of that balance sheet and start looking at capital controls? It was really interesting. We should talk about this, but there's the next big narrative is going to be this fiscal bill that's coming up. And in there's stuff like, taxes on remittances to other countries from US dollars and that sort of thing. And this is like full on capital controls. And that's sort of leading towards, I think, what you're saying, which is this Weimar-esque situation. And I think a lot of people, when they hear that, they expect it to come from the Fed. They think the Fed's just going to print a shit ton of money. But in reality, I think it's entirely more likely that it's going to be the fiscal side of things, the Congress people that want to just keep the Ponzi going because that's how they stay reelected, right? So, just bringing up, just looking at this potential bill right now, like we're in the complete opposite situation from a few months ago where the narrative was, Doge cutting $1 trillion and, balancing the budget, even though we said on the podcast that was a ridiculous idea and we go into a depression. Like now we're quickly seeing here just in some of these forecasts is the complete opposite situation. The deficits are going to rise further. I have this chart too, and I think I saw that you put it in here as well, Tyler, but just looking at the percentage GDP fiscal deficit, if this bill goes through, so we're at 7% GDP deficit right now. With this bill, we would see a net deficit expansion up to 8%. So this is going up, not down.
Yeah.
Doge is done. The game continues. The Congress people want to win midterms.
I mean, Doge, they can still cut from like places that are funneling money, laundering money. That's great. But I think the problems are so big at this point that you get in this nominal GDP targeting cycle. And I think what I'm saying is they're going to have to do yield curve control, and basically the money that will come from the bond market into equities, the great rotation, that's very possible, where if you have some sort of infrastructure plan or, tax holiday or whatever, they'll manufacture something to get stocks higher. And that's just the world we're living in right now. Is stock market is effectively a piggy bank for, the next generation's like lifestyle, because you can't save. I can't save 4% on the 10-year and pay my kids, daycare bill that's going up 15% every year. It's just not possible.